believe it or not, 39 people missed. Almost two-thirds, maybe two-thirds people missed. What's the problem? What's the problem? It's pretty strange. I made it easy, but people thought this is a difficult problem. But you know, it only asks projects operating cash flow, OCF. OCF is revenue times 1 minus T plus depreciation times T. So here, let me this is it, right? So, which will reduce manufacturing costs by 20,000. So that is revenue, I told you that, right? Saving is like making money, revenue. So 20,000 is revenue. And 1 minus T, margin tax rate 40%, 1 minus 0.4. Plus, depreciation is what? Machine cost 40,000, modification 10,000. So depreciable basis, $40,000 plus 10,000. That is 50,000, right? Then what? Then depreciation, the first year, 33%. So 50,000 times 0.33. So 50,000 times 0.33, 16,500. So OCF 1, here you go. OCF 1 is this one plus depreciation times 0.4, then what? Times 0.4, 6,600 plus 12,000 plus 6,600, 18,600. That's the answer. So as you see here, this is not a difficult question. Just OCF, we did OCF many times in class, but strangely, many people missed. So quiz taking skill or exam taking skill is that you read the question carefully and find out what the question is about.
Professor,
just simply, yeah.
Quick question, what is modification cost? I don't remember those in the examples in class. That's kind of what threw me up.
Yeah, modification cost is for you to do your business, you have to modify the machine, right? There is modification cost. For example, if you try to do catering business and you buy a truck, then what? You have to make sure that you put shelves, whatever, right? It's modification cost. So I told you that not only machine cost, but installation, modification, and also shipping and handling, all those costs directly related to the operation of machine, that should be included to a differential basis.
In your examples, when you did the modification cost, you added it to each year. It wasn't a one-time cost.
So we have a modification cost and installation and shipping, handling, everything. That's why you should not miss the class. That is just initial year modification. not every.
Perfect. Well,
Yeah.
if you look at slide 8, it gives you how to calculate the depreciable basis.
Yeah. Yep.
So if you follow that formula, you can figure out how to get your depreciation. What we did
Yep.
afterwards was adjustments on different problem wise.
Yeah. So that's why you should pay attention in class. In class, there are many assumptions, so don't assume anything. So that's why you pay attention. You have to be alert in class to just take it. Okay. So, thank you, Hector. Yeah, that is good participation. Okay, so that is, the problem, and that I didn't do anything special, just followed the, follow the lecture note. Yep. And then next is this. Let's just continue our discussion. And actually, as I showed you here, right? I showed you here. Everything is, this is what we did, like revenue plus depreciation times T. Always did that. And if you look at, like here, here, yeah, depreciable basis. Depreciable basis, equipment cost plus shipping, installation, and modification. Yeah, it's clearly show this one. So there is, so that's why you have to review. Yeah. Okay. So here, this was the last slide, and then like you have to remember chapter 2, how to calculate classroom example when there is probability, right? Probability, that is not real life. That is classroom example, and that you calculate real expected NPV and real standard deviation. True one, true one. So let's just second data. And we did this, right? This was what we did last class, 69808. Y1 is 3, probably 30%. And 29807, Y2 5 or 50, but you have to be consistent. And minus 4816 and 2. Either 352 or 305020, but 352 is better, right? Save your time. But you cannot mix 352, something like this. You cannot do that. You have to be consistent. And then second, stat, and it has to be one variable. Yeah, that's what we did last class until here. One variable, and down arrow, n is 10. 3 plus 5 plus 2 is 10. And x bar, this is x bar, right? 346. 346.43. And if you hit down arrow, then you will see SX. That is not the answer. SX is sample standard deviation, but 100%. 100% is what? Whole population. So you have to hit down arrow one more time. That is sigma x 260.27. Okay. Then standard deviation is what? 260.27 divided by 346.43.75. So that is how to calculate CV, okay? And once you calculate CV, then you use this one to compare CVs of other projects to see the relative risk of your company, or more relevantly, compare this one with this project CV with your company average CV. Then what? Then you will know that this project is more risky, more or less risky, or about the same risk as the other projects. So that is how to use scenario analysis.
Professor, I
Yeah.
kind of lost you in the middle of it. Would you mind doing it one more time just so I can take a look?
One more time of what?
How you calculated the number 346.43?
Oh, okay, that is basically from this table, right? From this table. So you have shown that getting 690.08 is 30% probability. Getting 298.07 is 50% probability. Getting negative 46.16 is 20% probability, right? Given that table, you calculate this one. Actually, you can do it by hand, like 690.08 times 0.3 plus 290.07 times 0.5 plus minus 48.16 times 0.2. That is a long way, right? Just simple weighted average of each NPV, right? Using probability as a weight. Then standard deviation is what? That is 690.08 minus expected NPV, that is 346.43 squared times 0.3, 30%, plus 298.07 minus 346.43 squared times 0.5 plus minus 48.16 minus 346.42 squared times 0.2 all square root. That is the definition of standard deviation when you have table and you have probability, right? So that's pretty cumbersome, right? But using your technology, all you have to do is second data, right? That's why I put it here. Data and stat, maybe data and stat. So then what? Then since we ask, let's just clear, second clear work. Next one is what? This one. So 690.08, enter. So X is the variable you want to solve for. And then Y is the probability. In this case, don't enter 0.3, so you should be enter whole number, so 3 enter. Next two is 298.07, enter. And Y2 is 5, 50%, 5. And X3 is 48.16, negative, enter. And Y3 is 2, 20%, 2, enter. And then what? Then you finish your data entry. So second stat. And don't forget that if you have lin, you have to change it to second set again, second set, until you find one variable. That's why I put it one variable here. Then what? Just down arrow. Just keep down arrow. And it's 10. X bar is 346.43, right? X bar. And forget about sigma x. So sigma x is, you should not use that. Sigma x is sample standard deviation, but this is whole population, 100%. So as sigma x is 260.27. Okay, that's how to calculate. And then what? Then CV is 260.27 over 346.43 and 0.75. Okay. So so that could be on the exam pretty highly likely. That's a good question. Yeah, clarifying question. Okay, so that is how to calculate CV, and then you use that CV to compare with other projects, mostly to your company average CV. Then you will see how risky your project is compared to your average project. Then, so this is a slight improvement over sensitivity analysis. Why? Sensitivity analysis don't just give you any probability or possibility range. Sensitivity analysis just give you facts, right? But scenario analysis gives you some scenario and some possibilities like this, right? So it is better than scenario analysis. So if you can figure out some probabilities, then you may set up scenario analysis in addition to sensitivity analysis. Yeah, maybe. Then your report may be more just complete. Then what's the problem with the scenario analysis? The problem is only considers a few possible outcomes, right? This is not real life. Real life, that is not just best, base, worst case, right? There can be second best, third best, also maybe thousands of millions of cases, right? So if you have even like 10 cases, that's not complete. So that's the problem. And that board problem is that assumes that inputs are perfectly correlated, right? That means what? All bad values occur together and all good values occur together. So it's like this. Best case, 130 units at 7% WACC, the best case together. And worst case, 70 units and 13% WACC. Sometimes that makes sense, sometimes that doesn't make sense, right? So you have to, sometimes two variables may act against each other. For example, price goes up, then what? Probably the quantity may go down, right? Price goes down, then people may not, demand may go down, so quantity may go down. Then what? In that case, price goes up and quantity goes up is the best scenario, but that doesn't make sense, right? So that's the problem. So the correlation is just not like reasonable, yeah. And also common disadvantage is what? It's all for standalone risk, standalone. So, but this disadvantage is same with sensitivity analysis and Monte Carlo analysis. That is what? Simulation analysis, simulation. Monte Carlo simulation, right? So simulation is nothing more than scenario analysis. But the difference is what? Is computerized version. So you use computer to run scenario analysis thousands of times, right? And you use continuous probability distributions. So computer selects values for each variable based on given probability distributions. So you have to specify so you have to enter information. then the computer generates the outcome. So that is, that was not possible because what? Doing scenario analysis 1,000 times, it's not economic and it is almost not possible before. But now, because of technology advancement, now computer is very just fast and very sophisticated now. So you can handle simulation analysis, right? So now simulation analysis is important. So we call it Monte Carlo simulation. And then you calculate NPVs and IRRs, and process is repeated many times. As I said, 1,000 times or more. And the result is that probability distribution of net present value and IRR based on a sample of simulated values. So what? Not only you have just one CV or one NPV, you have just a probability distribution. So it generally is shown graphically, okay, graphically. It shows you, and the result is probability distribution. So how your NPVs are distributed if you solve for NPVs, not just one NPV, but thousands of NPV, then you will see the distribution. And then let's just use an example. So you have to enter some distribution. So let's say a normal distribution, right? Normal distribution, as you know, you just normal bell-shaped distribution for unit sales. So unit sales, you just enter normal distribution. That's your input. So mean is 1250 and standard deviation 200, let's say. That is what you specify. But unit price use triangular distribution. Then triangular distribution is like this. Lower bound 160 and upper bound 250. Then what? Most likely is 200. So around here. Then what? The probability distribution is, this is most likely this highest probability. And then what? This is 160 is lowest. So you connect this one. And you connect this one. Oops. Connect this one. Like this. So it's like triangular distribution, okay? So this is highest distribution 200. So this is probability density function, right? Probability density function. Probability density function. That is what? This shows the y-axis shows the probability. So this one is highest probability. And this is endpoint. And probability will go up from 160 to 200. And from 200 to 150, it goes down like this. So this is one type of probability distribution. Like normal distribution is like this. Normal distribution, the mean is the highest, and left and right is just symmetric, something like that. So you enter this information, right? You enter this information. And then simulation process is that you pick a random variable for unit sales and sale price. Not you, but the computer pick a random variable, random number generator, something like that. And substitute these values in the spreadsheet and calculate net present value. Then what? Then you have one outcome, right? Then repeat the process many, many times. Then what? You're saving input variables and output, right? Then you will have thousands of output, right? You repeat. As I said, by hand is almost impossible. Takes too much time, but using computer, it just generate quickly. Then what? After 1,000 trials, you see that the mean number is 1260, price 202, net present value 95,914. Standard deviation of unit 201, standard deviation of price 18, standard deviation of NPV 59875. So 59875 divided by 95,914, CV 0.62, and the maximum number of unit 1883, maximum price 248. In that case, NPV is pretty high, 353, 238. And minimum number is 685, price 163. In that case, we have negative. Then what? Then it's very important is what is the probability of net present value greater than 0? 97%. That is what? Pretty high, right? So we know that using simulation, this project is pretty safe, right? 97%, you get just a positive net present value. Only 3% chance, pretty low, right? Only 3% chance of getting negative NPV. So it's pretty simulation, using simulation, you are pretty sure the project is not very risky. So how to interpret the result? So inputs are consistent with specified distributions, right? Like you enter this distribution, mean 1260 standard 201 is oh, here we go. 1250, 200. 1260 and 201, pretty consistent. And price mean 163, max 248. A minimum to 163, mean 202, max 248. And that is pretty consistent with your input. That is lower bound 160. So 163 is slightly greater than that. Upper bound 250 and 248 is slightly less than that. Most likely 200, and your mode was 202. So pretty consistent. So the mean net present value is 95,904. Low probability of negative NPV, only 3%, 97% height. And if you graph that, then what? Histogram of results. So you see some probability distribution like this, right? And as you know, there is this one is slightly shifted. You have to move a little bit. This one. Then what? The net present value 90. So this one between 90 and 12. So 90,000 it should be highest. So this one should go here, right? And this one should go here. And this one should go here.
Professor,
Yep.
if this is all done with the computer simulation, are we going to have a question that's based off of this or no?
Of course, I'm not asking you to do the simulation, right? That you can do simulation from like operation management course. They used to offer simulation course. So some finance students took that course and got some benefit, as I heard. But this class is just, you don't have to know how to do the simulation. I'm just, this is just general explanation. So you just understand there is simulation analysis, and then what? If you're interested in this one and you want to do it, then you probably have to take that course, how to do it, right? But here, this course, we just understand pros and cons of simulation analysis and what is the procedure, and that's all you have to know. Yeah.
Wait, I have a question. So there's people who really have to do this over 1,000 times? Because you said
No.
they do 1,000.
Yeah,
There's no quick
yeah.
way to do it. Like
Yeah,
I
as
would
I said.
these numbers. Huh?
So your question is not finished? Just go ahead.
Okay, wait, yeah. So there's people who like have to do this individually 1,000 times. There's no way they can tell the computer, like, I want to compute like this many times. Can you just run it 1,000 times for me? They have to keep just redoing it 1,000 times.
Exactly. So all you have to do is a command 3,000 times. The computer will do it, right? That's what why technology is good. Yeah.
Okay.
Before you have to do it over and over again, that will be really cumbersome, almost impossible. But now, these days, your smartphone is probably more. They just store more data than just room full of machines in 1950, something like that. So technology advanced tremendously. So this is now a possibility. Okay, so so it's pretty overwhelming for you to do it by yourself, but computer is nothing. Yeah, computer will just do it quickly. Yeah. So computer will show you. Yeah, as I said, I'm not asking you to do this result yourself, but just see what's going on, right? So simulation analysis is nothing more than, as I said, scenario analysis repeated many thousands of times, something like that. Yeah? So simulation analysis is kind of advanced scenario analysis. Yeah. Then what are the advantages? So for example, those things can be on the exam. What are the advantages, right? So you understand so all you have to know is what is simulation analysis and how to do it, right? But you don't have to just memorize this one. Those ones are just examples, right? This one is example. This one is also example. The simulation process, you just, see what's going on, right? And those are data. So those ones are just, you just generally just know what's going on. Yeah, that's it. Yeah. Then what? Then this slide may be more important. So what are the advantages? Reflects the probability distribution of each input. So that is big, just improvement over scenario analysis, right? This one, each input, you have probability distribution. And shows range of NPVs, and expect net present value, sigma and CV. Those ones are same as scenario analysis, but this one shows range of NPVs, more general range, overall range, right? Scenario analysis just only in like 3 cases or even 5 cases or even 7 cases, only that, right? Limited, but this whole range of NPVs. And gives an intuitive graph of risk situation. So if you see this result, you see that the project is pretty safe, right? You have all just positive net present values, 97%. Yeah. But, and also you have to know what are the disadvantages. The problem is we know that this is the best scenario analysis, right? But difficult to specify probability distributions and correlations. That is your task, right? If not, if you specify wrongfully, then what? If inputs are bad, then outputs will be bad. Garbage in GIGO, garbage in Z. So that's the problem. The technology is very advanced, but if you don't know how to use it, it's almost useless because you have to input correct just variables and standard deviations and correlations, all those things, pretty hard. That's why I recommend you take the course, right? This is not just 1 hour or 2 hour mastery. This one, you have to just study whole semester. So that is the problem, right? So that means what? If you know how to do it, you may be demanded. People may like you, right? So you are more just marketable, something like that, right? So you're just tool. Then conclusion. Conclusion is that sensitivity analysis, scenario analysis, and simulation analysis do not provide a decision rule. Why? They do not indicate whether a project's expected return is sufficient to compensate for its risk. The reason is they just show you just the fact, right? In other words, sensitivity, scenario, and simulation analysis all ignore diversification. So even though simulation analysis is the most advanced, still they measure only standalone risk, which may not be the relevant risk in capital budgeting, right? So that's the inherent risk. So those sensitivity, scenario, and simulation analysis only showed you the riskiness of your project, but you cannot just rely on those analyses to make a decision, right? So that we'll talk about that later, okay, how to make a decision, okay? But this one is just try to measure some riskiness of the project, okay? Then, one more thing, should subjective risk factors should be considered? Answer is yes. The numerical analysis may not capture all of the risk factors inherent in the project, right? That's the problem. For example, if the project has the potential for bringing on harmful lawsuits, then it might be riskier than standard analysis would indicate. So in that case, even though just numbers may show positive, like positive net present value, but subjective risk factors, like the project may just bring some, lawsuits, and then what? And you may lose the lawsuit, then what? It can be very risky, right? So you have to consider, and then what? And you have to think about how to include that, right? For example, you may just research possible just lawsuit and you how much money you have to like pay, something like that, then what? Then what? How much, let's say, because of a lawsuit, you may have to pay $1 million. Then what? Then you may have to just assign some probability, right? What is the probability of losing or the lawsuit, or what is the probability of lawsuit is even, right? Then you just may include that as a native cash flow, and that's safer, right? So you have to include subjective risk, right? You have to include. So those ones are just conceptual, right? Just can be on the exam as a multiple choice conceptual. It's not detailed, right? I told you that you may have to assign some probability, and you have to research how much money you have to pay when there is a lawsuit, those things. And then more practically, how to use those risks we measured when you evaluate the project. So we may use risk-adjusted discount rates for divisions. Let's say use plus minus 3, then it's like this. This is more practical and can be on the exam easily. So let's say your company has 10% just average just discount rate, cost of capital, right? Then here you have divisions. So high risk, medium risk, low risk. And this one is projects, high risk, medium risk, low risk, like this, right? Then plus minus 3 is easy. Yes, if it is for, let's say, medium risk divisions, higher risk project, you assign 3% more. A low risk project, subtract 3%, like 7% like this. And for high risk projects in high risk division, then you add 3, so 16%. And high risk projects in low risk division, subtract 3, so 10%. So that's easy, right? Just plus minus 3. So this one 13, this one 10. So if I ask, according to plus minus 3% adjustment, what should be the discount rates of low risk divisions, high risk project? Then what's the answer?
%10.
Check.
10.
Good answer. So that means you're paying your attention. That's good. So I told you that low risk divisions, this one, low risk divisions, high risk project, and what? This one, 10%. So that's easy. But sometimes you use plus 3 for more risky project or more risky divisions, or minus 2% for less risky divisions or less risky project. Then in that case, it's not easy. For example, let's use like plus 3 minus 2, like this. Then let's say 10% average, high, medium, low, high, medium, low projects, and these divisions. You know, it's sometimes it is difficult because if you use high 13, low 8 like this, right? But from here, high is what? High is 11% and low is 6%, right? But from here, high is 3% is 14%. But look at this, low is from 14 to 13, low is minus 2, but it's minus 3, right? So that is the problem, right? That is the problem. So, you know, the way of solving this problem is that you always start from the middle. That is very important. Always start from the middle. So everything has to start from the middle. Okay. So in that case, you know, the way to solve this problem is start from middle, 10%, right? Then you have 13% and 8%. And start from middle, so you have 13% and what? 8%, like this. Then what? Then you everything from the middle, so 13 and 16. And here, 11%, like this. From middle, 8%, 3, 11%, and 6%. So this is correct way, right? So then everything from the middle is plus 3 minus 2. Let's say if you are here, middle, right? Plus 3. So I'll show you this. If you are here, 13%, plus 3 minus 2, right? If you are here, 10%, plus 3 minus 2. If you are here, plus 3 minus 2. And also, in the middle is here too. Oops. This is in the middle, right? So from in the middle, plus 3 minus 2. So in the middle, plus 3 minus 2. One more. This is also in the middle, right? So plus 3 minus 2. So this is correct. So not this one, but this one is how to use plus 3 minus 2. Yeah. Now this one is also highly likely to be on the exam, right? Because this is the conclusion. Okay? How to use our risk analysis, actually use the information from sensitivity analysis, scenario analysis, and Monte Carlo simulation to make a decision. So that's what I'm saying. Scenario analysis, sensitivity analysis, Monte Carlo simulation is not generate decision rule. That just show you how risky. And then once you know the riskiness, then the decision rule is like this, okay? Plus 3 minus 2 or plus 3 minus 3. Plus 3 minus 3 is easy, so may not be on the exam. Plus 3 minus 2, you have to know how to, right, just do it, right, correctly. So, you know, if you do this way, and then if I ask you, according to plus 3 minus 2 adjustment, so this is division, and this is project. So what is like middle risk divisions, high risk project? What is that?
13%.
13.
Check, check. So that is answer 13. That is. That is medium risk divisions. High risk project. The discount rate of medium risk divisions, high risk project. So that is how to use our risk analysis. Then you may, another methodology is that you use project cost of capital. Project cost of capital.
Yes, sir.
Yeah, question. Okay.
Where did the 10% come from?
Oh, the good question. That's a really good question. Thank you for asking. Just the 10% is just example. I just pick number. Let's say, yeah. Thank you for asking. This is just example. It says given that the average cost of capital of the company is 10%. Yeah. Thank you for asking. Yeah, just this out of nowhere. I just made up. Yeah, thank you for asking. And then project cost of capital method is that use the divisional cost of capital method. Do you remember divisional cost of capital? That is from cost of capital, chapter 11, I think. Cost of capital. And you studied marginal cost of capital and divisional cost of capital. So you guys are not ready for the final exam, right? So the divisional cost of capital is, company has different divisions and all divisions have different risk. Then using one cost of capital is not fair, right? So we did divisional cost of capital method. So we tried to find out, divisions have no price. So we calculate, we use just pure play method. Pure play method. So you just pick several companies, like company, let's say A, B, C, D, and E, that engage in the same line that solely is important, solely they solely engage in the same line of business with the division. But now, instead of division, now you with the project. Then what? That is project cost of capital. So you just try to find out companies that solely engage in the same line of business with division, but in this case, divisional cost of capital. The same line of business with the project, then that is project cost of capital. And then you have to do something like, get unlevered beta, and you re-lever based on the project's capital structure, and then you calculate cost of equity using CAPM, and then you finally calculate WACC based on how you just finance the project, right? So that is a project cost of capital, but that is even more difficult than what? Divisional cost of capital, because it will be very hard to find just the companies that are listed in the stock, that are listed in the stock exchange to engage in only that line of business. Very hard, right? Solely in that line. But in that case, you may use some probability. How pure the company is, right? If the company has 80% of business in the line of business, then maybe 0.8, 80%, something like that. Beta times 0.8, something like that. So some weighted average still possible, but definitely it's not easy, right? So that is, that is same to divisional cost of capital, right? So it's hard to find a big company engaging only in that line of business, because conglomerate, they just engage many line of business, right? And then what? Still, the best way is how pure, right? So you may use weighted average. Let's say company A engage in this line of business, let's say 50% of their business is in this line of business. Then what? Times 0.5. But company B, almost 90% of their business is in this business. Then what? 0.9. So in other words, it's a weighted average of the betas. And of course, if you do that, it may not be very accurate, but that's the only way. You can just try to utilize the data and try to come up with divisional cost of capital. Pretty hard, but this way is pretty, just easy to use. And finally, another approach is certainty equivalent approach. Certainty equivalent. Certainty equivalent is like this. People don't like uncertain things, right? People like certain things. So for example, if you have choice that you will get certain $150, right? And two choices. You ask people, are you gonna get $150 that is sure, right? Risk-free. And or how about $20, but that's risky, right? Then if you are indifferent between getting a certain is important, certain dollar, 150, you will get 150 for sure. But uncertain, 200, expected cash flow is 200 is bigger, but it's not certain. There is risk. Risk means what? The chance of getting less than 200, right? It can be even less than 150. The possibility, right? That's why it's risky. But you are willing to take that because 200 is a lot bigger than 150. So just you are indifferent right? Getting certain 150 and uncertain 200. Then certainty equivalent coefficient, that is the CEC, certainty equivalent coefficient, 0.75, all right? 150 divided by 200, okay? So your certainty equivalent coefficient is 0.75 in the case. Then what? And it varies inversely with risk, of course, right? The higher risky, then what? You won't be satisfied with smaller uncertain ones. You require higher uncertain cash flows, right? So if it's more risky, then you will have, I'm not indifferent between 150 and 200. I'll be indifferent if it's more risky than 150 and 300, then what? 150 over 300 is 0.5, right? So the higher the risk, the lower the certainty equivalent coefficient, right? So using certainty equivalent approach is that rather than just risky cash flows, you calculate risk-free cash flow. Why? Risky cash flows, CF is cash flow, times certainty equivalent coefficient, then suddenly this cash flow is risk-free. Then what? The discounting, the general rule of discounting is that you have to discount cash flow according to its discount rate relevant to the cash flow, right? So look at this. RF is risk-free rate, right? So risk-free cash flow divided by risk-free rate, and then what? And then subtract investment, CF0, okay, your investment, CF0. And that is the NPV, right? So that is third way of incorporating risk. Certainty equivalent approach is that certainty equivalent. First, let's calculate how to calculate certainty equivalent. It's like this. If you expect 1120 in year one, right? Like 0, 1, 1120. And if your risk-adjusted discount rate is what, 12%, right? Then the present value is 1,000, right? 1120 divided by 1.121 1 plus R. That is 1,000, right? So the present value is 1,000. Then if somebody guarantees that is a risk-free in year one, that amount is a certainty equivalent, right? And that should be less than 1120 because it's risk-free cash flow. So if the risk-free rate is 5%, then what? Certainty equivalent divided by risk-free rate is 10. So this is reversed order. Before we calculate 1120 over 1.12, but it's reverse order. So we calculate, so 1,000 is already calculated. We have calculated in present value, but discounted by one risk-free rate, then what is certainty equivalent? That is what? 1050, okay? 1050 over 1.05 is 1,000. So certainty equivalent is 1050, right? 1050. So CEC, so this is how to calculate CEC. Certainty equivalent coefficient is what? Your certain 1050 or certain 1120 So certain one divided by a certain one, 0.94. So you will be indifferent between getting 1120 risky cash flow and getting 1050 risk-free cash flow, right? That is how to calculate certainty equivalent and certainty equivalent coefficient, right? And then, given that knowledge, our final slide is this. Certainty equivalent example. A project with a cost of 10 million is expected to produce cash flows of 5 million, 6 million, and 8 million for the next 2 years. Just like this. 0, minus 10. Year 1, 5. Year 2, 6. Year 3, 8, like this. Certainty equivalent coefficients for these three cash flows are 0, 0.8, 0.7, and 0.6, respectively. That means what? As you know, this is probably normal or reasonable. That is what? As the time goes, the distant future is more risky, right? Near future is less risky. That means what? Near future is less uncertain. The distant future is more uncertain. So more uncertain means more risk. So more risky. So look at this certainty equivalent coefficient going down through time, right? That makes sense. And risk-free rate 5%, then you just multiply certainty equivalent coefficient to this risky cash flow. So 5 million times 0.8, that is 4 million. 6 million times 0.7 is what? 4.2 million. 8 million times 0.6, 4.8 million. And divide by 1.5 year 1, 1.5 squared, and 1.5 cubed, and minus 10 million investment. It's 1.77 million. So accept the project. How would you solve this one faster?
On your
This
calculator.
Cash flow on the
Okay.
calculator.
Good. Calculator. So calculator cash flow. Great answer. You're right. So just rather than, so this is to like explain what's going on, right? But just when it comes to solving the problem, just cash flow and NPV, right? So using our technology, cash flow. Second, clear work. And CF0 is what? CF0.
10 million.
Check 10 million, but negative, right? Negative 10. Enter. And C1 is what? C1.
5 million.
Oh, be careful. Be careful.
4 million.
4 million. Yeah, because you have to enter certainty equivalent, not, yeah. If you enter 5 million, then what? Discount rate cannot be 5%. It's risk-free, right? But the risk-adjusted discount rate is not there, so you cannot use 5 million. Yeah, certainty equivalent, so that is what? 5 times 0.8, 4. But again, wrong answer is better than no answer, participation. And then C2 is what?
4.2.
Check, 4.2, 4.2, enter. And C3 is now obvious, 4.8, 0.6 times 8. And go to NPV, I is what? I.
5%.
5, yeah. Actually, there are only 5% there. So 5, enter. down arrow, compute. 1.77 million. So accept the project. So this one concept is not easy, right? And definitely you have to come up with certainty equivalent coefficient from your experience and from your research. But if this is on the exam or quiz, this is easy, right? All you have to do is multiply risky cash flow by CC each year, right? And using CF and NPV, I is 5%.
Professor, what did you put for CF0?
CF0 is this one, negative, this one, negative CF0, negative 10 million. Don't forget CF0 is investment, so minus 10. Okay. Any questions? Oh,
I was just gonna ask if you could go back one slide. I missed something.
one more slide. Go back here. Okay.
Perfect, thank you.
Oh. This slide is about how to calculate certainty equivalent cash flow and how to calculate certainty equivalent coefficient. That can be more difficult than this one, right? This one is probably easy, but this one you have to really know what's going on, right? Because first you have to calculate present value of risky cash flow using risk-adjusted discount rate, and then what? Then you know what should be certainty equivalent cash flow using risk-free rate. Then what? Then you calculate certainty equivalent coefficient by dividing risk-free cash flow by risky cash flow, right? So that is more understanding. But this one is easy. Once certainty equivalent coefficients are given, then all you have to do is just multiply that to risky cash flows. But don't forget that here 5% is given, right? But don't use risk-adjusted discount rate to certainty equivalent cash flows, right? Use risk-free rate cash flow, then use risk-free rate. Yep. So that's the end of chapter 13. So chapter 13 homework is due next Thursday. That is, believe it or not, just next week will be May 6th. Okay. Okay, then next, chapter 15, capital structure decisions, part 1. You know, in 304, we didn't spend much time on capital structure. This is more advanced stuff. So we use 404, we just have 2 chapters. First chapter is more like a general statement, but at the end, very important calculation, right? Actually, we calculate optimal capital structure with numbers. It's very important. And chapter 16 is more advanced stuff about theories. So chapter 15, topics in chapter: overview and preview of capital structure effects. So we'll just like, what is the what how capital structures affects company. And we think about business risk and financial risk, and how debt affect returns. And then we'll think about capital structure theories, evidence, and implications for managers. So this is important. How to choose optimal capital structure, actually using numbers. So we come up with some capital structure, optimal capital structure. So that is chapter 15. Then we have to review basic definitions. By the way, today's quiz will be,
That's at 4:30, Professor.
oh, thank you, 4:30. So still have 12 minutes. So V is value, right? FCF is free cash flow. WACC is weighted free cash flow, weighted average cost of capital. And you know that. And RS, S stands for stock, D stands for debt. That is cost. Usually R is return, but as I said, you know, investors' point of view, those are returns, but financial managers' point of view, those are costs, because you have to provide them the return they require to get their money, right? So that's cost. And W means weight, right? So W means percentage, but that is weight. W stands for weight. So WE is for stock weight. WD is debt weight. Just that is the review. Okay, we've been using that. And then, how can capital structure affect the value? This is from chapter 10, valuation. That is what? Free cash flow is for everybody, all the investors, right? Free cash flow is for all the investors. So you discount it by WACC, weighted average cost of capital, right? Very important. Always cash flows has to be discounted by its relevant discount rate, and free cash flow is for everybody, like stock investors, bond investors, preferred stock investors. So it has to be discounted by WACC, weighted average cost of capital. And here WACC is WD times 1 minus T after tax cost times RD plus WE times RS. And we skipped preferred stocks. Chapter 15, we have debt and common stock. Okay, so we skip preferred stock to focus on capital structure. And then preview of capital structure effect. The impact of capital structure on value depends on the effect of debt on WACC and free cash flow, right? Pretty obvious, because value is free cash flow divided by WACC. So the capital structure means how that affects free cash flow and WACC, right? So how that affects free cash flow? Pretty obvious, because value depends on free cash flow and WACC, right? Then what are the effects of additional debt on WACC? First, we think about WACC. So as you know, debt holders have a prior claim on cash flows relative to stockholders, right? If bankruptcy occurs, then what? Debt holders has to be paid first, right? And whatever is remaining will be stockholders. That's why stockholders residual claim. Residual means whatever is left after debt holders' fixed claim is satisfied, right? Then what? that increase the risk of stockholders' residual claim because they get money after debt holders are satisfied. They have to pay interest and principal to survive, right? And whatever is left is theirs, right? This fixed claim increase the risk. So cost of stock will go up by borrowing money, right? Because company become more, if you compare to 100% equity company, if you borrow money, cost of stock will go up because your company becomes more risky. But firms can deduct interest expenses, so that reduces the taxes paid, right? Deduction. And so frees up more cash flows for payments to investors, right? So because this reduced tax savings will then more cash for payments to investors. So that reduces after-tax cost of debt, right? Don't forget that. RD times 1 minus T, always after tax, right? So that will go down, right? Because of tax deductibility. So that is good point, good side of debt, right? And risk goes up is bad side, but reduce after tax cost of debt is good side. Then what? That increases risk of bankruptcy. So that causes pre-tax cost of debt, RD, to increase. So that is negative effect, right? Also, adding that increased percentage of firm financed with low cost debt, that weight, right? If you add more debt, then WD will go up, okay? More debt. And decreases the percentage financed with high cost equity, weight of equity. So in the case, low cost debt is higher than what? WACC will go down, right? So it's like the effect on debt on WACC, this one, WACC goes up, this one, WACC goes down because of tax effect. This one, WACC goes up, this one, WACC goes down. And this one, WACC goes up because the risk goes up. And this one, WACC goes down. So two effect goes up, two effects goes down. So net effect, uncertain. That's why capital structure is not easy, right? It's not easy. You know, adding that is in some sense good for the company. Good means what? Making more money. But bad for the company because the company becomes more risky. So the net effect is uncertain. Oops. So we have 29. So four more minutes. Then what? Then what happened? How about now, secondly, the effect of additional debt on free cash flow? Then what? Then, so now we are talking about, now is numerator, free cash flow. We talked about effect of debt on WACC so far, and now effect of additional debt on free cash flow. Additional debt increases the probability of bankruptcy. That's the problem, right? That is, because of that, the probability of bankruptcy will go up, right? And there are two kinds of costs. First is direct cost. Second is indirect cost. Direct cost is if bankruptcy happens, then you have to legal fees, you have to hire lawyers and so on. And fire sales, that is what? You may have to just sell at very low price, okay, to survive. that will reduce profitability definitely. But there is nothing compared to indirect cost, indirect. First, lost customers. You know, if you're a airline company, then what? People just make a reservation for, let's say, honeymoon. But what? If they heard that the airline is on the verge of bankruptcy, nobody will make a reservation with that company, right? Their honeymoon will be ruined. Or whatever very important trips, whatever, they probably, even if it's not just pleasure trips, not important, people will hesitate to make a reservation if the company go bankrupt. So that's big, the biggest lost customers. And reduction in profitability, productivity of managers and workers. That is what. If your company is on the verge of bankruptcy, then what? You, rather than working very hard, you may try to find another job, right? You may go to have a job interview, whatever. And also, it's very hard for you to focus on your work. That's a problem. Not only that, it's hard for you to hire competent managers, because when you are in financial trouble, then what, you have to hire very competent managers to survive. But what, if the rumor is there, your company is having trouble, probably it's very hard for you to hire competent managers, both ways. People try to go away and people don't want to come, right? And next is reduction in credit. For example, offered by suppliers like accounts payable. That means what? This one is significant for department stores. Department stores, they have to have just new product, especially women's clothing. They have to have fashion items and so on. And before, those suppliers beg you for shelf space and please just have our product. You can pay later. They begged before, but now, if your company is on the verge of bankruptcy, then they probably ask you to pay money, right? When you need cash, they ask cash for them to supply their merchandises, because your company may go bankrupt. Big problem, right? So that's the problem. So that is more interesting, but no more fun. So let's, again, don't forget that even though it starts at 4:30, allowed time is 9 minutes. Don't forget that 9 minutes. So even though the exam stops at 4:40, you may not able to submit. So from now on, if you miss the submission, there is no excuse. You get 0 point. So please do the quiz on the time limit, 9 minutes. Okay, so the password is 395.